What's going on, everyone? We're going to continue into the series about Know Your Options, and we're going to talk about one of the most entry-level strategies and one of the most critical to understand, the covered call, or otherwise known as the buy right. Let's go and take a look. So the covered call option strategy, what is it? Well, the covered call option strategy, also known as a buy right strategy, is implemented by writing or selling a call option contract while owning an equivalent number of shares of the underlying stock. This is considered a conservative strategy because it decreases the risk of stock ownership while providing additional income. So let me read that again. It decreases the risk of stock ownership, so it decreases the risk of holding a stock while providing additional income because you're earning premium selling an inexperienced trader on the other end of the table out of the money calls that you know will expire worthless, letting you keep that premium. However, it caps upside potential on a significant price increase. So, important to remember, it doesn't eliminate upside potential, it only caps it. But as a trader and an aware trader, you would know the opportune moment to buy that call back if indeed the stock started rising on you when you were selling a covered call, which is the only scenario you would not want to happen if you had a covered call open. Professional market players write covered calls to boost investment income, but individual investors can also benefit from this conservative but effective option strategy by taking the time to learn how it works and when to use it. In this regard, let's look at the covered call and examine ways it can lower portfolio risk and improve investment returns. So basically, when to run this strategy. It's very, very simple. So taking all of the terminology aside, when the IV percentage is high, when it's over, let's just say 120, it's a great time to sell covered calls. Why is that? Well, when the IV percent is high, or the implied volatility, it typically means that the options are overpriced. So you want to buy options when they're at a low volatility. You would like to sell options when they're at a higher volatility. When you don't expect much of a move to the upside is another time when you want to run this. So, for example, all of these retail stocks that are hyped up in social media, that is a great time to sell calls because that is what the industry is doing. That is what they're doing. They hype everyone up, they lure everyone in, and then they sell premium because those calls that everyone buys out of the money because, again, inexperience leads to them expiring worthless, which puts the entirety of the premium collected up front in the pockets of the call writer. So how to run the strategy? For every 100 shares you own of whatever stock you have, whenever you go into the options chain, and as normal, you're probably used to buying a stock contract, all you have to do is switch it to sell. So whenever you're selling, you're not technically selling anything. You're only selling the right for the buyer of your contract to be able to buy back 100 shares from you if and only if the strike price at which you're selling the contract at expires in the money. You've been on the other side of the table. How many times have you bought a call, it expires worthless, and you lose 100% of your investment? Well, imagine being on the other end of the table. Now you're writing the call to someone else who's maybe unaware that it's going to expire worthless because you're smart and you're going to sell it over max pain, which is an easy win. So not only do you get money up front when you sell this call, you say, hey man, I'm going to sell you this right to buy 100 shares for me, but I bet you this call isn't going to expire at $5 by this Friday. And he's like, you know what? You're on. Give me 10 of them. Stock price is currently at 2. So he buys 10 calls from you for a $5 strike that expire in a few days. He thinks the stock's going to go up at 5. You don't. That's why you sold it. You see the max pains at 4. So what happens? Well, 3 days later, the stock ran up to $4.99. Well, guess what? That's still out of the money, and you still get to keep 100% of that premium you collected up front. So you win, and he loses. And that's typically how it goes, especially with retail calls, or retail stocks rather, because retail does not utilize option strategies. So how this works. Using this example, down here at the screen, we can clearly see that GameStop calls all the way out at $137 are priced at $1.71 bid and a $2.01 ask. As a call writer, you never sell the bid. Almost, the exact opposite of when you buy a call. You never buy the ask. You always want to try to buy between the mid and the bid. You always want to try to sell between the mid and the ask. So ignore the bid. You want to sell between here and here. So basically what we're seeing, for every one contract that expires next week on the 18th, you could make, per 100 shares that you own of GameStop, you could make between $246 and $262 per 100 shares. Now that's all the way out at 130. So imagine the closer you get to the current price, the more you're going to be able to make when you're selling your contracts. Now, we checked Max Payne for this Friday. We're gonna try to sell a little bit earlier. You can do this weekly. And the reason why we like to do this weekly is because if the calls we sell expire worthless, we keep the shares, the premium, and we can do it again next week. Rinse, repeat, passive income. It's amazing. Max Payne is 109. Using our Discord's handy dandy Max Payne bot command feature, Max Payne is 109 for this Friday. That means we could likely safely sell calls well above Max Payne at $125, at which point we would receive anywhere between $50 and $56 per 100 shares with little to no risk. A riskier bet, closer to Max Payne, if we were to do it at 110, it would be $190 or between $182 and $190 per 100 shares. So with anything, you want to judge the situation, see if it's a good time. Has GameStop ran in a while? Is there a bunch of hype going around on social media? Is there no reason for that hype? Look at the open interest. Is the IV high? This is one critical indicator. If the IV's high, it's a good time to sell. And remember, when you're selling calls, you're not selling anything other than the right for the buyer to buy your shares back from you, only if it expires in the money. So, possible scenarios. The stock goes up, you will still make money because you're holding GameStop shares, but it would be capped. And you would also be able to buy the calls back before you got into too much trouble because, again, you're aware of what's going on. Now, as long as the call you sold doesn't go in the money, there's no reason to buy the call back. The exit strategy I always have with covered calls is if it goes in the money, typically a good time to get out. But not always. But as a beginner, that's a good rule of thumb to have. Now, there's another situation. The stock trades sideways, which is what happens the majority of the time in GameStop. Mind you, how many days do we run? 1, 2, 3, 4, 5, 6 days off the top of my head? How many days have we not ran? How many weeks have we not ran? The majority of them. So, therefore, the stock trades sideways, the call expires worthless, stock goes down, the call expires worthless, and you just made money holding, and you're still bullish on GameStop. There is nothing wrong with that. Now, most traders don't exercise their options, and most options expire worthless. So that is another advantage right off the bat. I've been down 500% before in Webull. Guess what? My shares never get called because no one exercises their options. It's monetarily does not make sense, especially with stocks at a price like GameStop. Down at penny stock level, different story. But this is a way for you to take those shares you've invested in and start paying yourself back for holding them so damn long. You deserve it.